Hey guys, welcome to this video. Just a quick rundown on gold following up from my stream this morning. There's several things you'll need to know before you trade this. I'm going to start off by doing a quick recap of what we looked at previously, why and where we are now and how to go forward from that, because there's a ton of lessons you can learn on a market like gold after it ranges really high and dealing with the fall afterwards and anticipating the fall as well. So previous high we saw up here, I said a billion times, a gazillion times, short, short, short. I did posts on it. Loads of people saw it. Thousands and thousands of people saw it. Hopefully they were short because you saw it fall here, you saw it fall there. And as a smart trader, well, okay, maybe, just maybe, it might fall again from from the same place as it fell twice before from extreme highs, okay? So you had your high, all right? Almost an all-time high, I think, if you look along, okay? So yeah, you've had that. The time's over. Now, if you just flick down a time frame to your daily, suddenly the market starts to crumble and it starts to come down and push up and come down. And you're shorting this all the way down. I would hope you're shorting these mini pushes up. Now, I said for a long time, exactly where I've highlighted it, I said for ages, every single push is getting battered away every time. So yes, you should be lightly short. And if you look to the long side, I said, okay, well, if the market's pushing up and coming away every time, surely there's not enough buying power, and therefore that weakness is going to crumble through. It goes in line with market sentiment as well, with the changing global economy, people pulling out of gold a little bit. So that's what you got now. Every single time you've come down, you push up, down, up, down. Okay, so we basically said eventually this is going to come through. Every single push is just too weak. So where are you now? So you've come under these lows. You didn't sell your house and go crazy and lose everything, which is really good. And the market is pushing under. And what will probably happen is that you'll peel away from these key moving averages. Remember, moving averages are simply magnets for price. They come back and push away. As you saw all these other times, the market comes back to moving averages and comes away from them. So knowing that knowledge, knowing we're likely to pull away slightly further, if you go on your weekly, you can suddenly see that when you put that time frame up, you're actually above the MAs, okay? And you're impending a fall towards them. So using that knowledge and also the fact that the stochastic oscillator is really low, we can assess, would we like to long now? Now, the reason why I'm not longing yet is because if you go on these higher time frames, there's no significant price action zone until you get to about 1870. And I don't need to rush in. I'm willing to let the market move. And I know because there's weakness in the market now, okay, again, much like I said before, these really weak pushes, if there was impetus there, if there was buying power or key significant price action zones we were falling to, it wouldn't look like that, okay? So you're just peeling and peeling and peeling down. Now, if you do get a bounce, that's great. That's fine. But if I trade risk averse, I'm inherently more safer in the market. So I'm letting myself just drag down to these key moving averages right here. You've got your 40 moving average, you've come below your 20, you've got your 40 moving average slightly to slide up, as is your 100 and your 200. And the 200 gives me basis for my further DCA point. So throughout all of this, you're looking to DCA. You're not looking to get one massive trade and make loads of money. As the market falls, you're scaling into the long side because your job as a trader is to attain that market value as the market retraces back from those previous highs. You've done with shorting, you're finished with it. The only time you would ever want to short this, okay, is if you really push up and you get a rebound like that and you're in line with that 40 MA, you've gone past your 20, that would be ideal for risk averse shorts, in line with this downwards trend that has come off from the highest point in the market that you had. Remember, we're trading in stages and we're DCAing, okay? We're looking for a pop and then short, or we're falling to key price action on higher time frames and we're getting long. Our risk is always asserted in a way that allows us to manage our capital long term. So no matter how far the market swings, we can end up dealing with it quite well. I hope that helps, guys. As always, if you want to get my free webinar training, just go under this video, click the link. And of course, I'll see you in the next one. See you there.